Good afternoon, everybody. I'm Shannon Derehove. Welcome to today's webinar hosted on behalf of ESG Africa Conference and Expo, where an expert panel will delve into the rapidly evolving world of sustainability reporting, one that extends far beyond an organization's own performance to encompass the entire supply value chain. The webinar will provide practical insights, lessons learned, and tools to help organizations develop a roadmap for improvement, one that ensures reporting is not just a compliance exercise, but a valuable tool for business growth and sustainability. Before we start, please note that the chat and the Q&A are available to you. Please post your questions in the Q&A and your comments in the chat. Both the Q&A and the chat are at the bottom of your screen. Please be aware that we are recording this webinar and we'll send the recording to you when it's available. We're also streaming the webinar live on YouTube and we'll share the link in the chat once it becomes available. So let's get started. Today's moderator is Wendy Poulton. She's the Director of Strategic Mindsets, a company specializing in strategy and risk consulting and coaching. She's also the co-founder of the ESG Africa Conference and Expo. Wendy will facilitate the discussion with today's panel, which consists of Clémence McNulty, Partner for Climate Change and Sustainability Services at Ernst & Young, and Lwandle Mqadi, a Responsible Investments and Sustainability Specialist at the Industrial Development Corporation. I'll hand over now to moderator Wendy Poulton to start the discussion. Over to you, Wendy.
Thank you so much, Shannon, and welcome everybody. I think we're really excited to be having our first webinar of the year. And it's on a very hot topic about ESG and sustainability reporting. I think the session that we had at the conference on this topic was like completely packed. We had to move the room so that we could put more people into it. So we really understand that it's a topic that is consuming a lot of your attention and time at the moment. So we want to make the session as interactive as possible. We only have 2 speakers, and we did that deliberately so that we can really have a lot more question and answers and discussion amongst the participants. So we're going to start off just by, as you heard, Clémence is from EY, so she interacts with a number of clients who are grappling with reporting and all the changing standards. And Lwandle is from the IDC, so she comes from a very financial perspective. And really, the finance sector is driving a lot of the reporting requirements that we're seeing. So we're going to get 2 really different perspectives. So I wanted to start off by asking both of the panelists to just give us their perspective on what they see the major trends are at the moment in reporting. And we've called this webinar Reporting Along the Supply Chain, given the importance of SMMEs in Africa and the requirements now not just to report about your own issues, but along up and down your supply chain. And so, Clémence, let's start off with you. What do you think is happening and you've seen happening in your experience over the last few years? And what do you think is going to happen with reporting over the next few years?
Thanks, Wendy, for the introduction and for the question, which I think covers two kind of key areas. First of all, what are we seeing in terms of sustainability reporting and how is that more broadly impacting supply chains, value chains, and as we know, significant potential impact in terms of African value chains going into different parts of the world. So I guess the starting point always for me is to say, whilst there's a lot of developments, this is also not new. So, you know, questions and reporting within supply chains has actually been around for quite a while and has certainly increased. So whether you think of the Dodd-Frank Act, which I think was in 2010 around conflict minerals, that speaks to certain mining commodities, where you think of fair trade type of certifications in the agricultural space, or even just requirements around health, safety, ISO certifications that we've had. This has been something that's increasingly been driven, and it's been driven by obviously the reputational impacts if your risks in the value chain are not well managed. So we've seen, clothing companies, I think Nike and various ones being in the news at times, not for the right reasons. And that's really driven the activity. Where it's really changed is that obviously there's been a focus on trying to standardize and drive more consistent and systematic sustainability reporting over the last, let's say, 4 years, especially with a focus on climate change, because we know climate change is one of the key systemic challenges that we have and increasingly impacting companies, investors, and obviously also supply chains. And in terms of that development, we've obviously seen different speeds, different standards emerge. But if you think about the European standards, which are, the Corporate Sustainability Reporting Directive, the CSRD, and I apologize, it's a bit of an alphabet soup, but it's lots of acronyms. But the CSRD really requires companies to start reporting consistently around the sustainability impacts, risks, and opportunities that they face across environmental issues, social issues, and obviously governance issues, and to take a value chain lens to that. The other standards that we've seen emerge and really appear as what is intended as a global baseline best practice is the International Sustainability Standard Board's standards, the ISSB, which are really part of the IFRS Foundation, so linked to the accounting tradition that we've had, and are aimed at providing decision-useful information around sustainability for investors. Those standards also require thinking about the value chain and the sustainability aspects through your value chain, as those might impact ultimately your ability to create value as an organization. So with the rise of those standards, what we're seeing is we're moving into a space as those standards become potentially mandatory and more regulated, where there's a much more systematic look into supply chains. Those standards obviously have progressed. Most of them have passed. The adoption pathways are different. In South Africa, we don't have yet a specific standard that's been adopted, but we have an active discussion in jurisdictions like Nigeria and South Africa. We have an adoption pathway for the ISSB. I think the one overlay to that, and if you think of going forward, what's likely to come is there's a whole set of regulations in Europe that were designed to go further into the supply chain. So there's another piece of regulation which was expected this coming year, which is called the EU Corporate Sustainability Due Diligence Directive, the CS3D, which was expected to have quite big impacts on supply chains, where European companies would have to ask their suppliers around performance on environment, social commitments to net zero, and also lots of regulations we saw, I think, previously last year around deforestation that speaks to the agri sector. And then there's been a lot of talk about digital passports, this sort of full value chain linking of the products as they go through, so we can bring in more circularity. The one obviously big elephant in the room that we have to address is that with some of the geopolitics and developments that are happening and the EU struggling with competitiveness, there has been a bit of a rethink around some of those regulations. There's an omnibus package of simplifications that's expected from Europe towards the end of the month, early March, which is widely expected to lead to probably a slowdown in some of these regulations coming through, and maybe the thresholds being revised. So my general sense is that the standards are being set. Companies are moving towards them. There's still a recognition that we can only have robust supply chains and address some of the bigger systemic challenges that we're trying to address in terms of sustainability if we move to consistent reporting and everyone is trying to manage these issues in the same way. But with the current geopolitics, there's likely to be some reprioritization and maybe some nuances that will come through. Unfortunately, the geopolitics also means that there's probably more fragmentation in terms of the direction that we take, and it might become a lot harder for certain companies, especially if they're serving multiple markets, to navigate that complexity. Because before, we seem to have general alignment around the way forward, and now it's looking obviously a little bit more fragmented, which is difficult when we know Africa is typically at a crossroads and is playing across different areas. So how companies manage that might actually be more complex, unfortunately.
Wendy, you're muted.
Apologies. Thank you for that, Clémence. Lwandle, from your perspective, what are you seeing happening? And if I can just remind everybody, if you've got questions, please put them in the chat or the Q&A session, not the chat, and then we will start addressing them. Thank you.
Thanks, Wendy, and good afternoon to colleagues. So with that brilliantly set scene, we've had to grapple with all these things that are happening within the IDC. And I'd like to summarize how we viewed it as the Industrial Development Corporation. For those who are not familiar with us, we are a funder based in Johannesburg, funding Sub-Saharan Africa, and our mandate focuses on sustainable industrial development. So that's what we do. We're owned by the South African government, even though we operate independently from them. We raise our capital in both national and international markets. So in grappling with all these emerging frameworks and standards that have been mentioned, what we had to do was to basically set the scene for our executive and our board. And we came up with about 5 things. For us, when we spoke to them, we said to them, there's this standard that is coming, the International Financial Reporting Standard, starting the 1st of January 2024, and we need to do something when it comes to this reporting and disclosures. We also raised to them that we now have a Climate Change Act, and in the Climate Change Act, if you read it, it's already giving a signal that we will need to communicate and disclose sectoral emissions targets. So for us to start preparing for that, we need to put something in place. And luckily, we also have a responsible investment policy. And in that policy, one of our principles that we had highlighted was that we need to be very clear to our investors and our business partners start articulating what our baseline is in terms of disclosures, particularly on emissions. We need to start a process of getting to a point where we set targets. And we also even mentioned this in our integrated report to say we are starting the process of putting this in place. But most importantly, what we articulated to them was that as a development finance institution and a public agency in South Africa within the financial services sector, we've got already the Johannesburg Stock Exchange, who's already started talking about, they released the other year their disclosures. So that's how we packaged it for our executive and our board. And that was enough for them to say, we get it, we understand it, how do you approach it? So it was also there was a methodology. They wanted a process, a very clear process on how we're going to get there, where we start saying, we've covered all these disclosures that you've had being mentioned. We've covered all the indicators and all the matrix that we've put in place. So we said to them, before we get to that point, let's see what we've been able to put in place. So we already have a climate change response framework as the corporation, which is referred to as the IDC Pathways for Sustainable Industrial Development. We've already initiated the process of accounting for our baseline financed emissions. We're doing that from a bottom-up process where we're engaging our business partners, where we're using the greenhouse gas protocol to actually account for this. But we also have a top-down approach where we're trying to understand basically our financed emissions, and a lot of colleagues in the financial services sector are going through that. We also have initiated a process of understanding what our climate risks are and opportunities, most importantly, within our portfolio. As I said earlier on, we're in the industrial space. So as you would know, we operate in a very carbon intensive sector. So it's very important for us, whilst we realize the risks, be it transition risk for those entities who are exporting, and for those entities, the physical risk for those operating in the agribusiness space and others infrastructure space, the opportunities become very important for us as a financial service sector and as a player who wants to drive industrialization. So that work has already started. But then also, we also realized that we need to put, as I said earlier on, a structure on disclosures. We also wanted to be very clear that whilst we're doing this, we need to start thinking about the products and fundraising that we need to do to finance all these activities, because it's not just about disclosing and reporting. It's about how do you utilize that to leverage the funding that you're going to be looking for in the market, or the products that you want to create for your clients, so that they actually get better rates. And for that, it's not just about rates, it's also about the requirements that are required from them after that. There's a lot of reporting, there's a lot of disclosures if they are to go for this new form of funding. So that's how we've incorporated all of these standards and frameworks that are out there. And all of that we utilize into coming up with a set of matrix. And I must say we ended up with 14 metrics in the end, and I'll talk about those 14 metrics. I'll go through them once we start as we continue talking. But that's a little bit of background, Wendy, on how we got to where we are when it comes to disclosing. So for us, it was just not about one disclosure. It was just not about once, following a certain report, or even though we've been doing integrated reporting for a while. For us, it was about how do we update our integrated report, but how do we ensure that we evolve as new frameworks and standards are happening, bearing in mind that whilst we may have listed entities in our portfolio, but we've got a large part of it is unlisted entities, mostly SMMEs, and mostly entities who may not meet some of the threshold. But in doing so, what is the regulation saying? What are the standards? How do we also ensure that we are able to provide what our investors are looking for? As you would know, a lot of investors and funders who invest in our business, they are looking for us into disclosing and reporting as much as possible and in the latest standards and framework out there. And that's how we basically captured everything. And we came up with a list of matrix that we will, and those matrix, we've also set timelines on them. So over the next 5 years, we'll be going through all those matrix and trying to integrate them into our sustainability reporting. So that's a little bit of background on how we've approached this as the IDC. Thanks.
Great. Thank you so much. Clémence, if I can come back to you. I know that the IFRS is now doing sector-based standards and together with IISB. Do you think that's going to help with perhaps streamlining some of the reporting requirements, and particularly for SMMEs in that sector? Will it help narrow it down, or is it going to make it more complicated?
Yeah, so I think so what ISSB has done, ISSB integrated the SASB standards, which had specific KPIs and sort of matrices around potential issues that might be relevant in terms of ESG by sector to help reporters. And the ISSB is currently revising those sort of tables and trying to see if what is relevant and how to update those to help. What the ISSB is also doing is they're looking at additional standards more on thematics. So obviously nature, biodiversity, and then and specifically on human capital, because at the moment the only standard that we have that's thematic is climate change, and the other one is a broad sustainability one, which I think does mean that there's a little bit of uncertainty for certain companies as to what they should be reporting. So I think the sector-specific standards will help, and obviously we know the CSRD, the European standards, are also likely to publish sector-specific standards. So ultimately, it might lead to more clarity. I have a sense that if you're in the supply chain of a sector, you have a pretty good understanding of the material issues that your consumers are facing. And I think where the standards become really useful is that it just becomes, this is the consistent standard piece that we want. But from a starting up point of view, most of the standards have leveraged existing frameworks that we had, whether it's a GRI or other tools. So I wouldn't wait until those sector standards are available, if that makes sense, to get going, because there's already a lot that you can probably do, if that makes sense.
Yes. Do you want to add anything to that, Lwandle?
Yes, Clémence, that point of just what you've just touched on, that, you know, how these standards or frameworks, whatever you call it, are always borrowing from each other. And it tends to be on the other side as a user, it tends to be very confusing because you're not sure what kind of data now that is required and how different is it from what you've been doing in the past. So I just wanted to raise that. And I was looking at the 14 matrix that we ended up with. And if you read them, it may sound as if it's the same thing, but it's not. So ranging from a report to opportunities and all of that. But I just wanted to raise that it has been such a challenging experience trying to say how they are being interpreted by the different standards and frameworks. And whilst you're doing that, being aware that a new standard and framework may be introduced in the upcoming year, so that struggle, and that's why you need to draw a line in the sand and say, this is what we want to do for now, and these are the timelines we're setting ourselves. And data is such a big part of that. It's always good and well to, if the data is very inward looking. For example, from a financial services sector perspective, how we operate. But when you start including business partners whose business, that's not their core business, a business which is manufacturing shoes, they're not going to sit down and basically look and go through IFRS 1 and IFRS 2 and look at what GRI was doing, or is asking for what, what the Johannesburg, disclosure, standards are looking for. So it's, that balancing act, it's been very interesting. And also communicating this, because we pride ourselves in hand-holding our business partners. What is it that you want your business partners to disclose to you over time? What do you start with? That, that interaction and that choice that you make as a fund and say, in the first 5 years, perhaps let's just stick to your energy consumption, because I will get to understand where you are when it comes to transition risks, and maybe physical risks. I'm going to add them on year 3. And maybe when it comes to water consumption, that's an easy thing that you can provide for me. But, that balancing act for those entities, especially for SMMEs. And then, of course, on the other side, you've got business partners who've been doing this for 20 years already. They know how to do this. They are disclosing this because they are listed. And how do you balance that out as a funder? So those are some of the questions which we're continuously grappling with. And that's what I wanted to add, trying to evolve and trying to catch up all the time. And it's a struggle. It's a struggle, I must say. Yeah.
Thank you. So I wanted to just, one of the questions that has been raised in the chat by Priska is one that I wanted to ask you guys as well. So we'll start again with Clémence. you mentioned earlier that Europe has put in the corporate reporting standard directive, and that there's others to come, but there's also things like the carbon tax or border tax adjustments. And the Europeans, although I understand that what you were saying, that they're slowing down a little bit because of competitiveness issues, especially with the attitude of the United States on some of these issues. But what does that mean for Africa? Because ultimately they're going to go in that direction. It may just take a little bit longer. But how do we in Africa manage with that kind of increasing? Because a lot of the time you're not given the grace, like Lwandle was saying, to implement stuff over time. It's if you want to be a supplier, you have to comply with X, Y, Z. I mean, the green hydrogen regulations are a classic example of that. So how do we as Africa deal with these increasing global standards that are coming out when we have so many SMMEs in our value chains as well?
Yeah, Wendy, and it's a difficult one. So I think just to reiterate, I mean, it's quite an interesting time to work in sustainability at the moment, with some of the sort of geopolitical dynamics and some of the narratives and things that are coming through. But there's definitely a recognition in Europe that some of these regulations are not just impacting, let's say, African SMMEs, but actually impacting European SMMEs. And so there's this real focus on simplification, slow down, and making sure that it makes sense. I think I read the other day that even on CBAM, which is a carbon border tax adjustment that you mentioned, which is another way that reporting on carbon would get taxed in terms of the value chain if you've got a much higher carbon content than goods produced in Europe, to stop unfair competition, is going to be only applicable to probably 15 to 20% of the initial set of companies that it would apply to, just to catch the biggest emitters and to not create more burden for everyone else. So I think there's going to be a real focus on thinking about that burden versus the benefits, and any regulation that we have, even in a South African environment, will go through some sort of risk assessment, cost benefit analysis to ensure that it's fit for purpose. The reality is, we know that if you look at South Africa specifically, and it's not the same everywhere in Africa, obviously we've got 54 countries and they all have very different energy mixes and very different, mixes in terms of their economy and the sectors that they have. But in South Africa, we do know that we have a high emission electricity tied to our coal generation. And we know that I think South Africa is around the 12th biggest global emitter, and we will get penalized for that if we don't transition as we go forward, because we know that the focus on climate mitigation is going to continue, and it's going to continue to be rolled down by companies as they make net zero commitments. First of all, they tend to address their own direct emissions, so what's typically called scope 1 and 2, but very quickly move on to the scope 3 piece. And for a lot of companies, that scope 3 can be quite significant, and that's where they'll push it into their value chains. So I think, the reality is there are some areas where we need to be clear that if we don't act now, we will get more and more penalized. So I think climate and energy and moving towards a less carbon intensive supply and driving efficiencies in that space is going to be value adding on both fronts. On the social side, it's always been a challenge. I mean, there's a lot of discussion around, child labor in Africa, in agri, the way that it plays into societies. And, obviously there's a European lens or a global North lens that's not always appropriate, and that needs to be nuanced. But at the same time, I think we also know that we need some rail guards. So the alignment of programs to the broader, let's say, national development plans or SDGs is absolutely important. And one, I think, of the opportunities, and it's difficult to change that mind space. And I know, Lwandle, I think you shared your experience that it's sometimes onerous and you're spending a lot of time. But one of the big changes that I could think can come through from this reporting is that it's also forcing some of these big consumers to go and say, well, we need to have a much more collaborative partnership approach with our suppliers. So, whereas we had something that was quite transactional before, how do we now work with our ecosystem of suppliers to either drive circularity or better social outcomes? And then we can also communicate to our broader stakeholders that are looking for this as part of that. So it's also finding those co-benefits and being able to speak to those partnerships. But the reality, and I think just to close off, I know on the deforestation regulation, I've had a few comments that, in South Africa, we've got typically very active programs around indigenous invasives and getting rid of them, which obviously has huge benefits from a water point of view and is more sustainable, but might be seen as deforestation by others when it's actually beneficial deforestation, and it's difficult. So how do we articulate those nuances? And I think that's where it becomes particularly important to also have that open line of communication where you're able to articulate, well, this doesn't fully make sense. And it's difficult to do, but I think there is mechanisms to do that, and going back to that collaboration piece, there's huge benefits once these things start to be discussed.
Yeah, so I think that's a really critical point, that if you do this correctly, there are benefits to it, whether it be that you're going to get concessional financing or better rates, as Lwandle was saying, or that you can have efficiency improvements along your supply chain because you're working with and reporting and finding out things that you didn't necessarily know. But there was a question in the box from Tando in the Q&A to say, what happens if you don't have the information, and how do people work with their supply chain to help them get the information? And I wanted to add a follow-up question to that about auditing. So we know that the European directive talks about auditing being mandatory for sustainability information as well as financial. How do you think that's going to impact that relationship, especially if you don't have the data? How do we start helping some of those SMMEs to do that? Do you want to start with that, Lwandle?
So we've been lucky because we've been in the space of development impact. So as a country also, we've been lucky because I don't know whether luck is is an appropriate word. So when it comes to jobs and accounting for jobs, we know how high our unemployment rates are. As the corporation, that has always been one of the key indicators. And of course, the matrix associated with accounting for jobs, the type of job, and all of that, it's something that my colleagues play around with, and they've got their formulas and all of that. But, as a developing country, for us, when we talk about impact, in a way, we've been able to define that. So we've actually leveraged on that. For us, development impact has been about jobs created, employment created, the participation of women, the youth, new industries and new value chains that have been created. So those indicators that basically talk to where we operate, it's been easy to actually get that information from our business partners because it's something that they are trying to achieve, especially SMMEs. If you talk to an SMME, they will always tell you, I want to be able to employ at least 5 people, and I'm making sure I'm employing the youth. And in this area in which I'm operating, we've never had such services. So it's been very interesting for us, and that's why I refer to them as business partners. They have been able to basically articulate those indicators to us So when we speak to our investors, we don't come up with, they give you your list, but we are able to push back and say, but our SMME clients, they are creating these new entities and they are participating in townships, they are participating in special economic zones. And this is how they were able to get into those, be it special economic zones, and this is why they are creating these, township entities within what we call the township economy. So we've not come up with our new indicators and matrix. The entities themselves have basically articulated to us, and we've basically packaged that and said, if we are able to fund these people and these entities who are able to do this, then that's what our development impact is all about. And it actually makes it easier when it comes to auditing. And this is the space that we have not participated as much as we would like to, sustainability assurance. And we all know how assurance you need to have, your procedures in place. You need to ensure that, everything is in line and you've got the right policies and all of that. So this is a space we're getting into, but we're very cognizant of the fact that it still needs to be the indicators and matrix that are familiar to our business partners, which is what they presented to us when they came for funding. So that's how we've approached it from an SMME perspective. And if your client tells you, I don't have information on emissions, you don't say, oh, what is it? What energy are you utilizing? Oh, this is my bill from City Power. This is my a bill from Joburg Water. That's all I can give you, but I don't know how much I'm saving. You leave it at that. And over time, they will tell you, actually, I'm paying less now when it comes to water, just to give you an example. And these are the interventions that I've put in place. So that discussion with your business partner becomes very important. And we have most of those discussions during due diligence. And now realizing that it's not just about getting that information during due diligence, it's about the post-monitoring now, because it is in that context that you are able to come up with a contract that is appropriate for your client. You are able to say, whilst I'm giving you funding for this, will you be able to continue providing this information that you've provided to me through our discussion? And it becomes an interaction. So post-monitoring and providing assurance, sustainability assurance, it's a new area that we're exploring and that we are setting up within the corporation. It has to do with data, I'm afraid to say. It has to do with setting up systems, data systems. It has to do with a lot of data scientists being employed, because a lot of data analytics will come through, and the reason you're doing that, you want to be able to report and disclose in the end. And that's how you raise capital in the markets. So that's how we've approached it. Same thing with our suppliers, same thing with the suppliers that supply our SMME. So even SMME is very much aware that you'll be asking this, they start asking similar questions to their suppliers. Of course, big entities, they've been doing that but it starts there during our due diligence, that discussion when you are before you bring in the clients, you need to be having those discussions with them. It's taking longer. We're DFI, we take longer than others in providing finance, but there's a reason for that. We always criticize for that, and we're trying. It's going to get longer now because now we're asking for more information. But people are used to us asking for impact information. But it's how do we become more information as we pursue that impact information. And of course, we always try and give a better rate in the end. So that's, and I'm smiling as I say that because I don't want to take my colleagues on that, but that's how we've approached it. Yeah.
Yeah, so I mean, I think you answered that question really nicely, that it's basically risk-based waste, and it's all about materiality, right? You start with the things that are biggest, and then you can expand later, if you need to. It's just whether or not that will be sufficient for overseas markets, I think, is sort of the question that we're not certain about. So I'd also like to ask the question about the United States, because we know that, and how we think this is going to, if anything, change reporting. So, I mean, they are big influence, and Yeah, Clémence, do you want to have a go at that? We know that they've sort of pulled back on a lot of ESG issues. Do you think that's going to impact the drive, or is it just going to slow it down?
Yeah, it's a really interesting question. One I get pretty much 10 to 20 times a day at the moment. And it's really difficult to keep on top of. So the reality is that we knew with the new administration coming in, and before it came in, that a lot of issues, especially around climate change, obviously the US leaving the Paris Agreement again, would get deprioritized, and certainly impacted. We knew that the new SEC chair that would likely be appointed would probably stop the process around the climate disclosures that had been proposed by the stock exchange in the US. So we've certainly seen that slowdown come through. I think it's been a little bit more of a surprise. Some of the or maybe not, but certainly to some of us maybe has been how aggressively we've seen things like DEI be pushed back, and obviously that's starting to come through in terms of any companies that have government contracts. I think Accenture had a pretty public change to their D&I commitments, and we've seen large companies in the US make that change, not always supported by their ultimate customers and their employees. So I think that's going to be one of the big questions. The one that struck me the most was, I think, one of the executive orders this week was the stop of the Department of Justice enforcing the Bribery Act in the US. And obviously that's a huge one to consider if you think about global supply chains and the way that we think about corruption and ethics and the real pain that we know that we've had locally, and how much it can impact an economy. So there's certain areas like governance where I think we expected maybe not so many changes, where potentially we might see quite significant impacts. Having said that, Wendy, my answer typically is, whilst a lot of these things are being rolled back, pushed back, and there's maybe challenges to climate science, the reality of climate science hasn't changed because of the new administration. The risks and impacts that we're seeing come through haven't changed. The economics of a lot of the renewables and new technologies that we've come through are changing because of tariffs, but at the fundamental level, the investments are still going through, and some of these economics remain in place. And I think the expectations of large portions of the population for, and employees for keeping D&I programs, or at least ensuring that, some of these things are in place, again, hasn't necessarily changed. So what we'll see is, I think, this slowdown, this rethink, and certainly the EU has articulated that simplification, maybe slightly longer periods, but the direction of travel ultimately, I think, is not going to change. And I think the part that's actually really sad about this is that because we have more fragmentation for companies that are in the middle of these blocks that maybe are trading into different areas, the complexity is going to become more significant, because you're going to have different expectations being driven by different sets of investors, different set of stakeholders, by different value chains. And if you want to keep on having all of the areas, you're going to have to navigate these different standards. And absolutely, Lwandle, I think you made a point about the equivalencies between the standards, but there's slight nuances, and it's one of the things that we recognize absolutely, is that there was initially, and over the last couple of years, we'd seen this relatively strong movement to go in the same way. And now we're going to probably see these different speeds and different approaches. And that is going to mean more complexity. Yeah.
Yeah, it's going to be really interesting to see what impact that has on supply chains and funding capital flows.
Yeah,
Lwandle?
I don't think I can add. I think you've articulated that very well, Clémence. But I think people mustn't also forget this has never been a climate discussion. It's always been about our development. That's where our discussion started. And then climate, came through and it became an added risk to our development. As long as people remember that this has always been about our development and the impact that you want to make, be it through the funding that you put in or through the services or through your interaction with your clients. The discussion has always been about impact. So internally, we don't see these changes as affecting how we view or how we measure development impact, but more so about how will these change? How are these changes affecting our journey towards development impact? So that's what I wanted to add into that. And I see there's a question where somebody's asking if I can share the matrix. I can't, but let me just give you an overview, and I'm going to go through this. And please, Wendy, we separated them into two. So there are those where, and we did, when we did this assessment and research, and the team in our research, they said, what are frameworks and standards out there? So we separate them into two. So the eighth, that's where, there's reporting that is required. So it's your report on your board oversight on climate-related risk, report on management's role in assessing, managing climate risk and opportunities, a report on impact of climate-related risk, report on resilience. And I'm just going through matrix, how you are interpreting them internally. That's another story, and how you're combining them to actually respond to this. That's another story. But I just wanted to go the list to also illustrate the number of requirements which are out there, be it using IFRS S1 and S2 or GRI or JSE disclosure matrix. But when it comes to reports, they are more around your board, your management, your processes, your organizational processes in identifying climate risk and opportunities. So those reports are always required. And what we've done is to actually look at how do we come up with one report which can respond to all these other matrix. So that's on the reporting side. On the disclosure, a lot of focus is made on emissions. So there, as I said earlier on, we've started the process of disclosing our emissions and accounting for our finance emissions. So that's one part. And the other part is around disclosing our transition risk and physical risk. And then the reason why we've separated reports, the other one is report, the disclosure one, there's always a metric that you need to associate, that you need to put in place, be a percentage or a rand value or revenues or all of that. So on the disclosure side, the same thing becomes a little bit tricky where you'll want to define your transition risk and your physical risk, the opportunities in either percentage or revenue, disclosure of capital deployment. That's another one that we've seen coming up that we are also looking into putting out there. Capital deployed towards development impact, most importantly, and towards your sustainability transactions. Disclosure on internal carbon prices. We know entities like Eskom have always had an internal carbon price. It's something that we're exploring, but we're not sure whether we should be doing that in an environment where our basically national carbon price has been set. There's a disclosure on remuneration, and if you're a South African company, that you're already doing and it's already out there. And then there's another disclosure which is emerging, which is around adoption of ESG ratings. So we see a lot this coming from our rating agencies who basically rate us as a funder. They are asking us, what is the rating that you are utilizing to basically assess whether what you're doing is the correct, what you are doing is, you are doing what you're supposed to be doing. Are you reporting sufficiently? Are you disclosing efficiently? So that's how we've separated the 14 matrix. It's on reporting and on disclosures, and the disclosures talk to the rand value amounts or the percentages. I just wanted to give you that without sharing the whole document with you. But that's how we got to that. Whether that's enough or whether we need to do more, we'll do that but that's what we could manage with the time we had, and that's where we are at the moment. Yeah.
No, thank you. I think it's really important, and thank you, Clémence, for your comments. We are going to be having a whole webinar on the impact the change of policy in the US and what that means for ESG and for Africa. Not the next one, but the one after. So it's going to be an interesting discussion, I think. But I wanted to pick up on what you were saying, Lwandle, about impact. So could you just, I think that's really important, that we also moving, one of the trends I see is we're moving away from just this reporting on metrics to reporting on impact metrics. And that is so important for Africa, but also very difficult. Does anybody want to comment on that? And then I want to talk a little bit before we close about technology. I see that Trevor has raised it in the chat as well, about what are the tools that we need to help support us and our supply chain with all this reporting. Clémence, you want to talk a little bit about the first part?
Yeah, and I guess Wendy, sorry, I'm just trying to recall the first part, but
it was about impact reporting.
Yeah, and I think there's many theories, and I think it always depends if you're an optimist or a pessimist. And I've seen lots of people say ESG will come back more robust, and it was maybe too broad before, and hopefully this will mean more discipline in terms of what we mean, and more rigor in terms of what we mean. And certainly everyone has continued to recognize that it's the more we integrate that impact piece, with positive impact for shareholders, but obviously positive impact for broader stakeholders, the more we will get to that stage where we're achieving that shared value. I mean, the reality is there are examples of companies that are focused on that. And, with climate change, we've got a couple of areas where, especially around circularity, we've seen some interesting ones. I think one of the areas where we're also seeing some interesting ones is around carbon offsets. How do you kind of work through your value chain to potentially inset into your value chain some of these carbon benefits and bring them in? And obviously in Africa, we know that there's lots of potential there. So there's lots of areas where we're seeing those collaborations. The key thing is starting from that point of we move away from the transactional to a much more collaborative process to identify the joint opportunities. And I think there was a point, on the technology, and I noted it, but I think where we see really interesting innovations for small scale farmers, apps where they can plot their land, where they can, report back very easily in terms of amount of pesticides that they use, the different things, but also their buyers might be able to feed in, advice around planting cycles, whatever they're seeing in terms of weather patterns that might help. Those apps, on a mobile phone, low tech, but can have really big impacts and are solving for both. And there's a lot of those examples out there, which I think are really useful because they're helping the local impact, but they're ensuring that you still have that access to global supply chains.
Thank you. I think we had an absolutely fascinating webinar at the end of last year on technology for development and how technology can help, as you say, in agriculture, but in so many other sectors as well. But I think what I'm really interested in is about the reporting side as well. And how can we use artificial intelligence and other things like that? And what are the other tools and technologies that we can use to help, especially SMMEs, ease the burden of reporting? Lwandle, do you want to comment on that at all?
Yes, and this requires its own webinar. So colleagues may be familiar with the fact that we host a number of social funds, and they're familiar with the Social Employment Fund. Always amazed when I attend the sessions from the Social Employment Fund. They've got what you call SIPs, and these are the entities across the country working in different sectors, working with a number of partners. And this is just not, one type of investments that the Social Employment Fund does. So the use of technology in reporting on the people they've been able to employ, which is one part, but reporting on the activities that they are able to do due to the intervention of the Social Employment Fund. And it's a space that is evolving, that is very interesting within the country. And we even have a fund now which is actually focused on innovation that is happening in the back rooms or in university rooms. It's been very interesting to see the kind of innovation, be it apps, be it AI, and we've got a dedicated fund which is basically directed to that. And this is coming from students in universities and technicons in across the country. So it's been interesting to see the investments made there and some of the social funds that the social funds, for example, the Social Employment Fund. So yes, that is happening. And technology is there and it's evolving and it's interesting. There's a lot of challenges around the IPs, the legal elements in it, the costs of doing that. But internally, as an organization, we're such a fossil. It's been a struggle for us, and I must be honest with you, we're not that advanced, and I would like us to be, and I don't know why. And it has to do maybe with the way organizations are structured when it comes to systems and procedures, and always ensuring that there's a policy, there's a system, there's a procedure. AI needs to, be integrated into that. There's a whole element on assurance. How do you provide assurance to that data that has been AI generated? So those are some of the questions that are still coming through, and I'm sure we'll get to that answer. So internally, we are behind. I don't know whether other colleagues, and I know the banks are in front of that, but from a DFI perspective, it's something that we have not invested time in, but our investee companies are. And then you also, your question around impact reporting. So internally, we've got what we call a development scorecard. And this development basically scorecard is separated, I think, into 4 areas where we've basically tried to understand what is a productive economy for us. And in that productive economy, what is productive? How would we rate or how would we report from a productive economy, since we are an industrial development funder? Same for social impact. And by the way, on the productive economy, that's where issues of the just transition have come in. And within those issues of the just transition, that's where we've included elements on climate. And I just wanted to highlight that we didn't start from a climate perspective. For us, the transition is more important. And as part of that transition, the plus is to ensure that climate mitigation and climate adaptation happens. But for us, sustainable industrial development needs to happen. So we've got the productive economy, we've got the social impact, where we're trying to understand what are the social indicators that are important to us. Of course, we've got the one on environmental compliance, but also development. What is it that our entities, especially our SMMEs, are doing beyond than just being compliant? We know we have all these regulations and acts and policies in the countries, but you'll be amazed on the emerging circularity opportunities that the SMMEs are finding on the ground, and that they want us to be aware of as part of development impact. Just wanted to highlight that on how we approach impact, because that's what you would see in our impact reporting through our integrated report. Yeah.
Thank you, Lwandle. So last question is actually one from Ellen, who was asking about examples, and coincidentally we were talking about that before we started the webinar, so the panelists won't be surprised by this last question. And I know I remember years ago BMW saying that if you wanted to be in their supply chain, you had to be ISO 14000 certified, and they worked with the supply chain to help them improve the environmental performance. But what recent examples have you got from your experience in working with clients and customers about where big corporates have really helped their supply chain with reporting specifically? Clémence.
Yeah, that's a good question. So the example that I gave on the app was linked exactly to allowing that reporting to flow through. So specifically, this was one where you can be a small scale farmer anywhere, and then you can walk around your field and take and that gives the coordinates of your plot of land. And this was in relation to the deforestation regulation. And then the supply chain that you belong to, so your ultimate consumer, had that linked into satellite data that allowed them to demonstrate, to take an initial picture, and let's say, you know, a year later, they would check and see, has there been any sort of change? So using that satellite data. And obviously that's a very efficient way to do it, as opposed to going in. And then through the app, they added lots of other features that were value adding around, you know, planting periods and regenerative agri. And so there was this kind of two-way flow that was identified. So that's one that immediately comes to mind, because I think it speaks to, you know, how do we help the person on the ground to get information back to us that we can use to demonstrate that we are complying with these regulations. And it's also acknowledging that it's going to be very difficult to do it if you got like a wide range of farmers. I mean, obviously there's been lots of discussion about AI and how some of these new tools can be used. I haven't seen any practical ones, but I think where there's definitely been some quite nice examples of engagement is also around making those marketplaces. So whether it's kind of circular economy, around the waste management piece, around recycling, and where we see usually lots of impacts is where companies start to work with a range of suppliers, and maybe not just suppliers, but NGOs that are already working in the space, and then bring all of that together. So those are the immediate examples that I can think of. But, you know, we also have a long tradition of, as companies in South Africa have had to, you know, support enterprises to develop as part of the broader BE codes, and certainly have had to try and bring in some of these new enterprises to make sure that they meet health and safety requirements and other things, where there's been that collaborative work, lots of capacity building, lots of training that comes through. And that foundation, I think, is a very beneficial one to expand to other areas.
Yeah, so you just add reporting and like capacity building and that kind of thing onto that. Yeah, that's a great point. Lwandle, your example?
I've given my example. Let me try. What I wanted to raise is it's I've also been looking at how in East Africa how technology has been utilized. I always find it interesting in the banking space, how technology and all these things that we're discussing, how they've been used to basically ensure access to financial services for people who've not been able to have access to that. And we've seen this with energy access in South Africa, and how we are all able to just buy electricity from our apps. And the reason I'm raising this, I think it's also not just about technology being out there. It's about it's about thinking. The thinking should be about how do you use technology to actually drive our development impact? And what is that impact that we want to drive? And how can we leverage on technology to enable that? And that's a space that I don't think we've been able to explore, especially in the context of South Africa, especially in the context of township economies that we're trying to drive as a country, the opportunities in special economic zones, the opportunities to drive industrial development, be it in a lower scale instead of a larger scale. So for me, technology, that's how I see it moving forward, being used to drive simple things, be it water access, energy access, information access for people to change the way they lead certain environments, but eventually to drive impact. So for me, that example, I'm always keen and I'm always in a lookout for those kind of technology. And that's a discussion we're having within the corporation. And that's why we've got the Innovation Fund. It's about how do you use technology and all these new emerging tools that are in the market to still drive development impact. And yeah, that's an example I would give that we've got the fund.
And your example of where one of your clients has worked really well with their supply chain to assist them with a whole lot of things, but reporting, which is our specific topic today.
So in the logistics space, it's been very interesting how the logistics, transport and logistics space, I think they're one of the sectors that are 2-3 steps ahead, because for them it's about tracking. For them, the tracking, the delivery, the partnerships we work a lot with NESPAs. They usually we have a partnership in place with them, but for us it was about how it started. It was to understand how the whole new space of new energy vehicles, how can we utilize basically to actually drive the space that they're in, be it in Amazon or Take a Lot and all of that. But it's been amazing to see the kind of data and the information that they're able to generate from that, even from you as a buyer and your, just to give you that example. So there are entities who are, for example, who are putting their fleets within Take a Lot or Amazon, and they're funded through us. It's been interesting to see how easy it is for them to report on our development impact indicators, how it's not a big issue for them. It's, oh, you're looking for information on this. This is what, it's easy for them. So technology is becoming such a crucial point in driving development impacts from that perspective. Yeah, that's an example I could think of.
Thank you so much. Totally agree. Yeah. Thank you, ladies. I was going to ask a question about TNFD, but we don't have time because we know that TCFD has been included in IFRS, but TNFD our next webinar is on TNFD and starting to unpack a little bit, because the reporting seems to just broaden and broaden and broaden, and now the data requirements for nature-based disclosure is becoming really big as well. But that's for our next webinar. So with that, thank you very much, ladies. I think it's been a really fascinating discussion, and I will hand back to Shannon.
Thanks, Wendy. And thank you to everyone for joining us today. It's been a pleasure sharing the topic of integrated sustainability reporting into the value chain with you. Before we wrap up, I'd like to extend my gratitude to our moderator, Wendy Poulton, and guest speakers, Clémence McNulty from Ernst & Young and Lwandle Mqadi from Industrial Development Corporation, for an engaging panel discussion. They've all contributed to making this webinar a success. If you have any further questions or would like to continue the conversation, you can feel free to reach out to us via email at shannon@creamermedia.co.za. And if you're interested in hearing more about the ESG Africa Conference, please visit the website at www.esgafricaconference.com. And with that, I'd like to bid you all farewell. Thank you so much for your time, and goodbye.